Hey everyone, Assalamu alaikum. I'm Bilal Kurd, and in today's lesson for A-Level Business 9609, I'm going to talk about investor ratios. And the reason I've chosen to talk about this topic is because most of the students, they seem to struggle when it comes to the analysis of such ratios, because that is what the majority of the examiner comments are also highlighting. So, in order to continue with today's lesson, the past paper that I'm going to use is going to be November 2015, paper 33, that's the third variant, and the case goes by the names Faraz Fruit Farms. So I would advise you to pause this video and for once, for better understanding, try to open this paper and try to go through the case. Extract pointers if you want to, so that you have a certain background information, the qualitative information that you may need to write in your answers. And as far as the quantitative side is concerned, I'll be here to assist you in the best manner possible. So we have this data, and as you can see that the examiner has provided us with 2 years of information that can be helpful when comparing and making a decision. But when you talk about ratios, whether they be profitability or liquidity, any specific category, if you talk about ratios, it's really good if you have been given data of the previous years, because that helps in comparison. But also, it's also important to have data about your competitors, and if they're very large in number, perhaps you can compare yourself with an industry average, right? So whenever there's a question on ratios, please do try to see if you are given data of previous years and of competitors as well. If any particular set of information seems to be missing from the case, it would be advisable for you to make a comment about it, that, for example, the knowledge behind or the industrial average data or the competitors' financial performance data seems to be absent from the case. Had it been provided, it would have been easier to assess the financial performance of this business with respect to its competitors, since the case study suggests that there has been an increase in competition, so on and so forth, XYZ, and you can build a regular chain of analysis. So since you now know what to particularly extract from the case study, let's go on with specific analysis. It would be then again advisable to calculate these ratios on your own, right? So the very fundamental ratios that are going to become a major part of your answer are going to be number 1, dividend yield, and number 2, the PE ratio or the price earnings ratio. So I would advise you to make one paragraph on the dividend yield and the other paragraph on P ratio. And then if you have any other qualitative information, you can add that perhaps in this paragraph. And then you will go towards the conclusion in which you are going to highlight your opinion. So as you can see that the profit has risen by 4 million. Whereas the dividend seemed to only have an increase of 0.5 million, which might depict the fact that the company is not willing perhaps to reward income investors, the people who are specifically investing for a certain year's dividend and maximizing their income. So the company is not particularly focusing income investors at that moment. But then again, if you move on, you can clearly see that the share price has risen by $3, which can be a strength for the business. All right, so dividend yield is 2.25. We are going to talk about dividend yield in detail in a little while. And then P ratio, you also have the answer 12.5. All right, now you are also given gearing ratio in case you wish to talk about the possibility of taking loans and XYZ. And then if you see that you are given some data where you can compare the performance of this business with another competing business or businesses in this case. And the last piece of information is the data behind the interest rates. So there are different pieces of information. One of the most common questions that student ask me is, say, do I have to write about everything that's given in the case, that's given in the table? Or can I cherry pick and discuss only those items? And my recommendation is always the same, that it is the matter that matters. So even if you're given a large pool of information, try to pick out the areas of information onto which you can develop a successful chain of analysis. In short, the most strongest areas. All right. So let's start off with the discussion, but before that, let's see the question. Using your results from part A and other information, advise FFF's shareholders. The question is asking you to focus and write from the perspective of your shareholders, not from the business, whether to sell or keep their shares in FFF. Now, if you were to look this question in that particular past paper, you may find this question to be of 16 marks. But since now paper 3 has changed and the maximum mark per question is 12, so I've cut it short to 12 marks. And I'm going to explain you the structure accordingly. So first of all, we are going to discuss a little about the marking criteria as to how assessment objectives are to be evaluated. So we have 2 marks for knowledge, which means that the candidate needs to present at least 2 content points. So 2 points from this particular table can be sufficient. Application is for 2 marks, meaning that they need to be pieces of information linked together. Alright? Then analysis of 2 marks. Now when I talk about analysis being of 2 marks, that's actually good, because if you are, let's say for example, making a paragraph on dividend yield, so you may choose to write a chain of analysis, meaning that you can, make a chain of arguments. Like for example, workers will be motivated if their salary is increased. Now, if they are motivated, it would result in better product quality standards and improve customer service. Alright? Then, which may lead to the business seeing improved rates of customer loyalty and increase revenue. Then, which will be very important for this business because its objective is to increase sales revenue. And since the market is very competitive, this can actually help to achieve that objective through means of a unique selling point. So this is a particular chain of analysis where you're linking a cause and an effect, then a cause, then an effect. And that's exactly what you need to do in at least one of those paragraphs. So if let's say for example you do this in dividend yield, you do not need to do this per se in the P ratio paragraph. Alright? Had it been of 8 marks, you would have to present a chain of analysis in both the paragraphs or both the points. But since it's a 12-mark question and analysis only constitute for 2 marks, therefore 1 chain of analysis per argument is enough. Per answer is enough. And then you have 6 marks for evaluation, which means that you'll be evaluating the points, the paragraphs alongside, and then you'll be presenting your final answer evaluation in the conclusion. Alright, so this is the marking. Now let's move towards analysis. First of all, if you talk about dividend yield needs to be compared with 3 pieces of information. So let's say if you're talking about dividend yield, the first piece of information would be to always check for the previous years. So whether or not 2015 may be good for you would depend upon what was the dividend yield in 2014. Has there been an increase? How much increase? XYZ. Alright. The other piece of information is to compare it with your competitor. That fine, okay, if you open the stock exchange, we have the best dividend yield possible out there, XYZ. But there's also a third source, and that is what? That is basically the interest rate, which is also known to be the risk-free rate of return. So the third situation would be to compare your dividend yield with the interest rate in the banks, because if I am an investor then my objective in life would be to earn as much money as possible. And in order to do that, if I were given a chance to either buy a company's share for dividends or to invest in a bank for getting interest, I'm going to compare them. So if dividend yield is, let's say, 5%, but me keeping my money in bank would give me a 10% return, I'm going to choose this. So there are three pieces of information which constitute for analysis of dividend yield. And then there are obviously reasons and impacts and then your evaluation as well. So let's discuss about dividend yield in this case. As you can see, the dividend yield seems to have fallen from 2.85% to 2.25%. And the reason behind this can be the lower dividend per share, because dividends do not seem to have increased the way they were supposed to be. And also the increase in share price, because your denominator is increasing in value. And since your denominator is increasing in value, it would give a lower answer. So an increase in share price might be a good reason, but the fall in dividends, as in respectively, or the slight increase in dividends may not be that good. So if you talk about dividend yield, we have already identified the reason, and it seems to have been falling from the previous year, which is bad for a specific type of investor, which is known to be the income investor, because the income investor is particularly after dividends in a company. Now, what choices would the income investor have? Remember that you're writing your answer from the shareholder's perspective. So if you were an income investor, you will try to find out if other companies are offering a relatively higher dividend yield. And so you quickly scan the information and you come to find out that other public limited companies are offering a 5% dividend yield, which seems to be higher. So given a choice, you may choose to sell your shares in FFF, get your money, and then, which will be beneficial for you as well because the share price has risen. So get your money back and then invest it in another public limited company. All right. But there's an evaluative comment to this particular point that you've raised. I'm going to talk about it when we are discussing the price to earnings ratio. All right. So one option for you is to just get your money back and put it into a competing public limited company. But let's say if you're an investor who is going for even the lowest possible return and not leaving it, so you may also choose to consider putting all your money in a bank deposit and earning interest rates. So in both cases, if you can see, in all three cases, whether it's past years or whether it's competitors' information or whether it's banks' interest rates, your advice would be for income investors to sell their shares and deposit their money elsewhere. All right. But whether or not they do this would depend on, this decision would depend on the possibility of interest rates falling in the future, perhaps due to a change in government's macroeconomic objectives. All right. Or the extent to which data behind the other public limited companies is not window dressed. And then there's another evaluative comment. Let's talk about it now, and you can also refer it in the P ratio paragraph. If you see, this business is a farming business. The name tells you, right? So farming industry has very different dynamics. Farming industry and cell phone industry are very different. So when you're talking about ratios, it's always good to compare it industry-wise. Like banking sector having different ratios because different requirements of liquidity, whereas construction industry having completely different ratios, right? But if you see in this information, both in the case of price to earnings and dividend yield, you're just given data for other public limited companies, not specific industry-wise data. And why do you need it? Because it may be possible that other companies in the farming industry may be having 1.5% dividend yield, lower than that of Farah. So that information seems to be missing, and it's a crucial, and it's an important piece and an extremely crucial piece of information that you need to develop your answers. So this can stand out as an evaluation in the same paragraph. So let's say if you were to talk about dividend yield, what you're going to do is you're going to use these line of arguments that we have already discussed. And remember that it's always good to make a short table like this of the terms and information that you're going to talk about in your answer. So dividend yield, PE ratio, you can even mention the proposed dividends or the profit after tax, whatever information you can scan out, you can skim out, and then you can go through that. All right. So these are going to be, you can pause the video and read through the comments. They are the same comments that we have just discussed, more or less. All right. So now we are done with dividend yield. Now let's talk about the other ratio, that is the price to earnings ratio. So when you talk about the price to earnings ratio, what I advise my students is to remember how this ratio depicts one thing that growth investors are particularly interested in. What does PE ratio depict? PE ratio of any business is going to talk about its growth potential. So the higher the PE, the higher the growth potential of the business. And who are growth investors and why are they so much interested in the PE ratio? Because growth investors are the ones who have bought a company's share not for dividends, but rather to see a rise in share prices. Because if I have bought a share of $7 and I get to sell it at $10, I get a $3 gain. And let's say the quantity is large, then obviously I'll be benefiting. So growth investors are not interested in dividends. They are the ones who are interested in making capital gains. And a company would only make capital gains if there is an increase in share price. And an increase in share price is basically the effect of a company's good image and profitability, which may only be possible if the company is expanding or investing into making itself better, which may only be possible if there are sufficient retained profits, and which may only be possible if you cut back on dividends so that you can increase your retained profits and then you can expand in the future, resulting in an increase in share prices and making these growth investors happy beyond measure. So growth investors are particularly interested in PE ratio. But if you talk about the formula of PE ratio, you have share prices and then you have earning per share. And this earning per share is basically the profit for the year per share. And we all know that profits for a certain year can be window dressed. So PE ratio is a ratio that is always susceptible to different forms of manipulation and window dressing. Then again, it becomes an evaluative comment for you to discuss. So if you see in this particular question, the PE ratio seems to have increased, which can directly be related with the increase in the share price as well. Also, if you compare it with the industry average, it seems to be higher than the industry average, which is also good. And the same evaluative comment that you can bring in this discussion is that you need a specific industry analysis. It may be the case that farming industry may have a PE ratio of 15 times, but that data or that information is not given. Alright, so let's talk about the discussion over PE ratio. If you can see what's written in red right here, they are the same comments. It has risen. It's good for growth investors. They are going to be more confident and optimistic about this company's future, which will possibly lead to an increase in share prices. But then again, you need, specific data, and that is a crucial piece of information that seems to be missing. You can also mention about the window dressing comment that we just mentioned. Also talk about how good the company may seem because share prices are not at all vulnerable to window dressing because it's controlled and determined by the market. So the company cannot fake its share prices, and the very increase of $3 indicates that the company has good prospects, good growth prospects. All right. So please do skip this homework. This was for my students. All right. So now, if you talk about recommending, it would always be good to first identify, if you can, the majority of either growth investors in the business or income investors in the business. Because since their intention behind investment is different, your recommendation would have different perspectives. So if I talk about growth investors in this case, it's actually good for them to keep their shares in FFF. But if I talk about income investors, it may not be that good for them, especially in the short term, because the company is not at all determined to increase dividends. But yes, if the company, since the company has a lower gearing ratio, the company can consider the possibility of taking out a loan and perhaps paying these income investor dividends. But that can also go to waste and can put expansion plans at risk, because the loans would come with a mandatory payment, and that is interest, resulting in lower profits for you. So your expansion plans may become slower than predicted. Alright? So your recommendation can first involve your opinion regarding growth investors and also regarding income investors. And then in the last, if you want, you can mention that ratios are only pieces of quantitative information, but whether a shareholder should keep or sell his or her shares in a certain business would depend on the non-financial measures of business performance as well, such as its relation with its customers and suppliers and labor and its CSR, its ethical stance. So ratios only provide a specific analysis and not a complete picture of the company's performance. I hope this helps. Good luck.